Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
Well, today we're going to talk about a topic that I think not many are talking about. If you will, we'll call it the elephant in the room. We're going to talk about wills, trusts, and more.
For many retirees, Social Security income is an essential part of their financial strategy. But what's the right time to file? Today, Logan and I are going to talk about financial planning for professional athletes.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Kaylee and Ryan from Buska Wealth Management and Buska Retirement Solutions. We're going to be answering some of your questions about planning for retirement. But if you want to see your question answered on a future segment, please feel free to email us at info@retirewithbuska.com. Kaylee, Ryan, thank you so much for joining me today.
Thank you for having us.
Well, today we're going to talk about a topic that I think not many are talking about. If you will, we'll call it the elephant in the room. We're going to talk about wills, trusts, and more. Planning for what happens if. So I'm going to start with you, Ryan. Something that not many people are thinking about, but they probably should be thinking about. Why is estate planning important, even for young people?
Absolutely. I think when we're young, we all feel pretty invincible. And then as life happens, we kind of realize life is precious, short sometimes, a lot shorter than we'd like it to be in certain circumstances. So it's never too early to start planning. The last thing you want to do is leave your family, kind of dealing with something that, on top of that tragic loss, they now don't know what to do or what you would have wanted them to do. And that can create conflicts, not only just amongst your family, but you don't want the state deciding where your stuff is going to go or where your assets are going to go. You really want to have your input and leave that, that last legacy where you want it going. So it's important no matter what age you are to have a plan in place and then obviously adjust as things come up, things like having kids or getting married, making sure, even if you're engaged, making sure that that person that you want your assets to be going to, if something were happening to you or to happen to you, that you've got that set up and that's pretty clear to everyone else.
Yeah, I think I heard a saying once of, you only really get to do that once, and you won't know how well you did it, but the people you love will know how. So start planning early. And Kaylee, there's a lot that can go into that plan. Can you talk a little bit about what are some of those essential estate planning documents that come into play when you're trying to prepare?
Yeah, absolutely. So when it comes to essential documents that you should always have in place, that would be at least a will and then a financial power of attorney for finance and then healthcare, just to make sure that your wishes are stated and your loved ones know what they are. And then from there, depending on what your goals are, I mean, if you are wanting to avoid probate, then the next essential documents would be a TOD or a transfer on death deed on all your properties, and also PODs on your bank accounts. Make sure that those assets, aren't just out in limbo and going through probate and at the discretion of the courts, like Ryan had mentioned. And then lastly, making sure that all of your investment accounts and your insurance accounts do have current beneficiaries listed on them.
So those documents will help families outline not only who gets what, but also who owns what and how that's going to transition. Ryan, I know there's a lot when you think about that important decision of who is going to get my assets, the things that I have to leave behind in this world. How can our audience choose the right beneficiaries for their assets?
Absolutely. Everyone's going to be different with that, right? So it's really where you want your assets to go. In Wisconsin, obviously your spouse, if you're married, is going to be the first place that those assets go. But if you have something, special wishes, things like that, say you wanted to go to your brother, or you have a child who has some needs that maybe your other children don't, making sure that those assets are allocated the way you want them is really important. The state may not see it the same way if you leave it up to them. And again, you really want to decide, you worked your whole life for these things. You want to make sure that the legacy you leave behind is your own and the way you want it to be. You don't want someone else to make that last decision for you, so to speak. So it's really important that you make those decisions. And there's not necessarily a right or wrong. You just want to look at, what are the needs and who do I want these to be going to?
Absolutely. So you've mentioned this a little bit. If you don't have a plan, then the state is going to step in. But can you talk about, Kaylee, what are the consequences of not having that estate plan? What does that really mean if the state steps in?
So then your assets would go through probate at that point. So if you don't, at the very least, have a will to say your wishes, a lot of times they will go by what the will says, but again, the courts, it's ultimately their decision. So protecting your assets, it also takes away your voice and your control of your assets by having your assets go through probate. So definitely establishing an estate plan will give you that control and that flexibility back, so you know what you've worked hard for is going to your loved ones or whatever charity or organization that you're passionate about. And I think lastly, the biggest thing would be disrupting the harmony in the family. Again, like what you had mentioned, you leave a legacy, but you don't know what it looks like after you leave, and all the chaos and the turmoil that can be left. And we meet with clients all the time that tell us, since my mom passed away or my parent passed away, we haven't spoken as a family, it broke us up because we were all fighting over the assets. And if you have a plan established, I think it just takes all of that guessing out of the game and that fighting. And then it just gives you your voice. And I think it's also very important to make sure that you're having that conversation with your beneficiaries so they know kind of why you did what you did. Mm-hmm. And then again, it takes, the blame out of some of your siblings or other beneficiaries at that point.
So it takes the elephant out of the room.
Exactly, yes, right.
Awesome. Well, Kaylee, Ryan, thank you both for joining me today and talking a little bit about this very important topic. And thank you all for watching. We hope you'll give this some consideration and think about your estate plan. We'll be back with more right after this.
The Tax Cuts and Jobs Act of 2017 reduced income taxes for many American households, but many of those provisions will expire on December 31, 2025 if Congress doesn't act. That could mean that you'll pay higher taxes, but you can take more control of your retirement by prepaying some of those taxes now at the current rate. Call us at 715-355-4445 or visit retirewithbuska.com for more information. Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Ryan Connor from Buska Retirement Solutions and Buska Wealth Management. In this episode, I'm going to talk about the right time to file for Social Security. For many retirees, Social Security income is an essential part of their financial strategy. But what's the right time to file? A NerdWallet article titled should you take Social Security at 62, 67, or 70 has some useful details. Now, there is a vast difference between filing at 62 and filing at 70. As many people likely know, the earliest you can file for Social Security is age 62. But if you do so, your monthly payment will likely be reduced because, as the article notes, most people aren't eligible for their full benefit until they reach age 67. Now, if you wait until you're 70, you'll receive as much as 124% of your full retirement age benefit. First, let's talk about the reasons to file at 62. While it is often best to wait as long as you can, there are some circumstances in which it is better to take it as soon as you are eligible. The article cites recent data from the Social Security Administration that found that the average monthly payment for recipients who are 62 is about $1,274. That number is 70% of what that recipient would have received had they waited to file until their full retirement age. Now, here are some of the common reasons for filing at 62. Number one, you need the money right now. Number two, you have health issues that could shorten your life expectancy, or you don't anticipating living beyond your break-even point. Number three, you're receiving early retirement from your employer, and those benefits end when you turn 62. Number four, you have dependent children or an eligible spouse who may receive a monthly benefit up to 1/2 of your full retirement amount, but they can't begin collecting those benefits until you begin receiving your own payment. Number five is that you're eligible for survivor benefits on someone else's Social Security record and want to apply at 62 and then switch to your own Social Security benefit when at or after your own full retirement age. Now, if none of those reasons apply, maybe 67 is a better retirement age for you. The average monthly payment for someone who's 67, according to the Social Security Administration, is about $1,844 a month. Now, in most cases, those filing for Social Security at 67 will receive 100% of the benefit that they've earned. Here are some of the main reasons people wait until 67, which again is considered full retirement age for most current American workers. First, you intend to continue working while receiving Social Security benefits, because at this point, the money you earn on the job will not affect your benefits because there is no more annual earnings limit. Secondly, you were able to wait until you were 67 but can't afford to keep delaying Social Security income any longer. Third, you don't anticipating living past your break-even point for collecting benefits at 67 rather than waiting until 70. Now, let's talk about the power of 70. Waiting until age 70 means you've reached the point where there is no longer a financial benefit for waiting to file. Let me reiterate that. Waiting until you're 70 means you'll receive 124% of your full retirement age benefit. The most recent Social Security Administration data tells us the average 70-year-old recipient is currently receiving around $1,963 a month. Now, here's a rundown of why you may want to wait until you're 70 to file for Social Security. Number one, you have other income sources and therefore don't need the Social Security income until you're 70. Secondly, you anticipate to live a long time. Number three, you understand that your benefits don't increase if you wait until after you're 70 to file. Now, working with a financial services professional can help you build a Social Security strategy that fits well into your broader goals and financial strategy. Before I sign off, I want to quickly address an issue that is on many people's minds: the future of Social Security. Now, if you've ever wondered whether Social Security will still be around when it's time for you to leave the workforce, you're not alone. According to CNBC, 72% of Americans share the same fear. But the same CNBC article quotes experts who say that the chances of Social Security going away completely are very low. Social Security benefits may change in the future. For example, higher earners may receive a reduced income replacement rate, but that's not the same as Social Security disappearing altogether. So if the thought of Social Security going away before it's time for you to retire keeps you up at night, you can rest a little bit easier. If you log into the Social Security Administration website, you can see what your benefit payout is likely to be. It is possible that policy changes may make this benefit smaller in the future, but smaller isn't the same as non-existent. Now, if you have questions about when you should file for Social Security benefits, contact our office today at retirewithbuska.com. Give us a call at 715-355-4445. We'll be right back with more Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review. You've worked hard to save money for retirement, but wouldn't you rather thrive and not just survive your golden years? My newly released book, Golden Rules of Finance for the Golden Years, offers key tips for managing your retirement money and ensuring you have a more complete plan to make your retirement dream a reality. Call 715-355-4445 or visit buskabook.com to request your complimentary copy today.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Ryan Connor from Buska Retirement Solutions and Buska Wealth Management. Joining me today is Logan Wohler. Today, Logan and I are going to talk about financial planning for professional athletes.
Ryan, why are we covering this topic today? It's not like our show is going to be broadcasted on the Jumbotron at Lambeau Field or in the Brewers clubhouse.
Well, first of all, it's an interesting topic. Pro athlete gets paid so much that their salaries are newsworthy, and I'm sure a lot of people are curious to know how these guys manage their money. Secondly, there are actually lessons that can apply to our viewers, even if our viewers aren't making the professional athlete income.
That makes sense to me. On that note, let's dive in. An Investopedia article titled Financial Planning for Professional Athletes, an Inside Look, paints a detailed picture.
That's right. Now, the first thing the article mentions is that pro athletes are famous for burning through their 6, 7, and even 8-figure salaries.
There's a lesson for our viewers right there. Don't burn through your salary.
Absolutely. If the guy making 8 figures can ruin himself by spending all of his money, so can our viewers. So spend cautiously, folks.
So what do financial advisors recommend to pro athletes, and how is it unique?
So the article points out that professional athletes may make more money than the average worker does in a lifetime, but this can create a false sense of security. Pro athletes often have quite short careers, spanning a couple of decades at most. So those headline-making salaries need to last a lifetime.
How do they make that happen?
First, pro athletes can make their money last by avoiding some common pitfalls. Now, many of these guys are young when they start making the big salaries.
Youth and money can be a terrible combination.
It sure can. And that's why many pro athletes burn through their money on luxury cars, expensive clothes, outlandish restaurant bills. They can also overspend on mansions, fall behind on taxes, get stuck with hefty alimony bills. The list goes on and on. Even noble things like trying to help struggling family members can eventually become a financial liability for these guys.
All right, so what should a ball player who just signed with a team for big money do?
Well, the Investopedia article recommends that athletes start saving as much as possible from day one. The article points out that you're less likely to spend money if you don't see it, meaning if your money is in a savings account, you're more likely to leave it there.
That's solid advice, in my opinion. If an athlete signs with a team and gets hurt and can't play, he can't count on that big money anymore. If he's saved his money, then he has something to live on while he figures out what he's going to do next.
That's very astute, Logan.
How do athletes get paid? Do they get paid all year round?
This is a great question, Logan. The article notes that many athletes only get paid during the season. So if they spend all their money on a fancy new car or a 100-room mansion, they may not have anything left to live on during the off-season.
All right, so after saving as much money as possible, what should athletes do after that?
So the article next mentions tax minimization strategies, such as choosing a proper domicile.
What does that mean? Does that mean they shouldn't buy sprawling mansions and built-in basketball courts and home theaters?
Well, actually, it means they should consider whether the team they play for is in a state that offers tax advantages for high earners. Athletes may be able to save money in one of the 7 no-income tax states.
But how many of those states have teams? Alaska and Wyoming are no-tax states, and they also have no pro sports teams.
Well, let's not get into those weeds right now, Logan.
All right. Moving on. What does the article say about jock tax?
So the jock tax is one of those things that is truly unique to pro athletes because they have to pay withholding taxes to every state where they play.
So when the Brewers go on the road and play the Cubs and the Twins, the players pay taxes in Illinois and Minnesota.
Correct. But they also get a tax credit in their home state for taxes they pay in those other states.
I'm suddenly glad not to be a pro athlete CPA.
I agree, but it would be great to be an athlete CFP.
Yes, it would. So if an athlete's home state has a higher tax rate, they could be surprised by how much tax they owe.
Right.
What about signing bonuses? How can those impact a player's taxes?
So if an athlete gets a signing bonus, they will only pay taxes on it in the state where they live, which means they can save money if they happen to live in a no-income tax state.
What about retirement accounts for these pro athletes? According to the IRS, the maximum amount you can put into a 401k for 2025 is $23,500. It's a tiny fraction of what many of these guys earn.
The article notes that most athletes have to put most of their investments into accounts that don't come with retirement account tax advantages.
So what kind of financial plan does the article recommend for pro athletes?
So the article suggests that a goal-based financial plan may be optimal for professional athletes. It says that a goal-based financial plan helps athletes focus on what they want for their future.
That sounds like it could help prevent athletes from developing bad money habits.
Correct. And the article also suggests that athletes should plan for 2 retirements. Their first retirement happens when they leave the sport, and then their second retirement comes when they leave the workforce altogether.
Their income dips after their first retirement, right?
Mostly, and oftentimes quite significantly. The jobs they get calling the action on TV or on radio don't pay near as much, and not every athlete gets big endorsement deals that last long after their playing days.
Not everyone is Derek Jeter.
That's right. And that brings me to the article's next point. Not every athlete earns enough to retire forever when their playing days are done. The article also points out that the transition from professional sports to a less exciting career can be a quite tough one. Having money set aside for you so you can live for a while and decide what you want to do next can make that transition a lot easier.
I can see that. Your whole life would change. It would make sense to take some time with that. So, what other things does the article recommend?
So the article states that one of the biggest challenges for athletes is managing personal relationships. Athletes often feel pressure to give back to their families and other people in their life who supported them on the way up. But this kind of financial assistance can easily get out of hand and end up costing the athlete way too much money.
That is interesting. I can imagine that it is especially common for athletes who grew up poor. I can also imagine that many friends and family members come to feel entitled to the money and use the athletes as an ATM. It's wonderful to want to help your family, but I would tell an athlete to figure out their budget and how much to save first, and then look at helping others.
Absolutely, Logan. The article also suggests having clear guidelines for helping others, figuring out a specific sum that you might give to your mom or your grandma or whomever. Be clear about how much people are going to get and make sure that they know that you aren't just going to hand out cash willy-nilly.
That seems like solid advice to me.
The last piece of advice in the article is to choose the right financial advisor.
That's solid advice for anyone, I think.
It is, but athletes are also often beset by people who intend to take advantage of them. So it's very important for them to choose carefully.
That makes sense. So, Ryan, what lessons can our viewers take away from this? Most people watching today aren't pro athletes.
First, I think saving as much money as you can from day one is good advice for anyone. Day one can be today. It's never too late to start saving. Second, having money saved for a transition can be a great idea. Career change is almost inevitable for athletes, but many of our viewers may want to change careers someday as well. And having money to live on while you're making that switch can make all the difference in the world.
Being clear about how much you'll help your family can apply to non-athletes too. Grandparents for paying for college, cars, and weddings, for example. Wow, Ryan, this conversation flew by. We're out of time here.
Yeah, you're right. And viewers, if you would like to talk about your financial plan, contact our office today at retirewithbuska.com or give us a call at 715-355-4445. And with that, we are out of time. We'll be right back with more Financially Speaking after this.
Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review. The Tax Cuts and Jobs Act of 2017 reduced income taxes for many American households, but many of those provisions will expire on December 31, 2025 if Congress doesn't act. That could mean that you'll pay higher taxes, but you can take more control of your retirement by prepaying some of those taxes now at the current rate. Call us at 715-355-4445 or visit retirewithbuska.com for more information.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time for you to get a second opinion on your retirement plan. Give us a call at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time, same place for another episode of Financially Speaking.
Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. But if you're like many savers, you probably don't know the total taxes that you could end up paying. At Buska Retirement Solutions, we believe information is critical to making informed decisions. So I want to share with you a resource that can help quickly evaluate your potential taxes in retirement. Visit buskaretirementtaxbill.com to generate your personalized report. And once you've seen your retirement tax bill, let's talk, because there may be ways to improve those numbers.